Hi, Chris. Good to see you. Today, we are talking about a smart alternative to high yield bonds. I don't need to tell anybody this, but 2022 was a really tough year for investors. And there are a lot of tools that people probably don't realize that the pros utilize, which are a great complement to traditional stocks and bonds. So, we're going to talk about structured notes, which have a unique source of risk and return. What is a structured note?
A structured note is really a bond alternative. In the world of bonds, there's two types, and that's pretty much sort of a corporate bond or a bond that is backed by a very stable company, and usually the yield is a little bit lower than would otherwise be. Then there's high yield bonds. High yield bonds have a much more attractive interest rate. However, they come with much more risk because they are tied to companies that have a lower credit rating. So with corporate bonds, you have a company with a high credit rating and a low interest rate. With a high yield bond, you have a low credit rating and a high interest rate. Structured notes are a wonderful alternative to both of those scenarios. A structured note is simply a government issued zero coupon bond. And we add to that a derivative around a familiar asset. And when I say familiar asset, I'm talking about maybe the major indexes like the S&P 500 index or the NASDAQ 1000 index or the Russell 2000 index. We can create a structure around those using derivatives, add those to the zero coupon bond, and that creates a structured note. And what that allows us to do is actually begin to design the downside protection on the risk side. It also allows us to design the interest rate on the upside. And it's a very nice alternative to gain a higher interest rate without exposing yourself to lower credit risk.
So now let's then break down the three kinds of structured notes that exist. And as we talk them through, we can look at this great chart of risk versus return. So let's start with principal protected. Who are they for?
Absolutely. A principal protected note is for someone who has a little bit longer time horizon, someone who is very risk averse and would like as much protection as possible in a particular investment. Think of a principal protected note like a CD. A CD is FDIC insured, meaning as long as the government's around, $250 of that CD will be protected. Structured notes are not FDIC insured, but a principal protected note is a contractual agreement with the issuer. And we work with major financial institutions here in the US and around the world to create structured notes. But the issuer guarantees the principal will be protected at maturity for that particular note. So you can have upside exposure, often with a cap or even sometimes with a lever, but at maturity, you're guaranteed that if that issuer is still in existence, then your principal is 100% protected.
Okay. And next on this chart, as we crawl up the risk and return spectrum here, we have income or yield notes. What are these?
Well, yield notes are very nice because that is when we really start to look at the bond alternative. A yield note produces a known interest rate, and that allows us to start to have what I call outcome based investing. So when we know the interest rate, we can start to plan income. And that's what yield notes are for and who they're ideal for. So, for any investor who's looking to generate income without having to sell equities, especially in a down market, or rely on high yield, high credit risk bonds, yield notes are a wonderful way to generate streams of income without picking up significant amounts of risk.
Okay. And then the last kind of structured notes, growth notes. Who are these for?
Growth notes are for those investors who don't mind picking up some risk, but also want to participate in the upward movement of the market. Now, the great thing about growth notes or structured notes in general, when we talk about the protection of the downside, but the great thing about growth notes is you can design a structured note that will mirror a stock on the way up, but will not mirror the loss on a way down. So at maturity, you may not participate, say, one to one on a loss, but you could participate perhaps greater than one to one on a gain. So growth notes are designed for appreciation. That's the growth side of a portfolio. That's the part where you want to sort of accelerate that portion of your holdings.
I know it's really important to you to make sure that clients understand products before they're investing in them. So, what are the risks that come with structured notes?
So I've been using the illustration of a CD, which is FDIC insured. As long as the government's around, the CD is around. Structured notes are not FDIC insured, and there's that risk reward. As we talk with principal protected notes, as long as the financial institution is around, your principal is protected. For yield notes and growth notes, we start to build in downside protection through what's called barriers, meaning it will absorb volatility in the market down to a set percentage, say 30%. That means that the market can move 30%, and at maturity, if it moves less than 30%, your principal's secure, which we love. And along the way, you're earning interest, which is ideal. With growth notes, much the same way, is we build in what are often called buffers, where we don't participate one-to-one on losses like you would on stock. So at maturity, it buffers or lessens a potential impact to an investment, while on the upside, we can participate one-to-one or even perhaps greater than one-to-one.
So, now let's talk about the problems that structured notes could solve. Is this something for my lazy money?
Structured notes are great for lazy money, and lazy money is often okay. Well, that's for the super conservative investor who sort of stuffs it under the mattress. But one, not is it not making any return, it's actually losing because of inflation. So your lazy money is actually degrading 4, 6, 7% per year just based on inflation. Structured notes are a way to put that money to work with some downside protection that will allow that money to work as hard for you as you did for it, and get it off the sidelines, get it off the couch, and let it go to work.
How about adding protection?
That's what I like about structured notes is when they're designed, we know what type of protection is there. With stocks, okay, it's sort of hold on for dear life and what's going to happen. With structured notes, you can sleep a little better at night because when you design a note, when you invest in a structured note, you know what the downside exposure is, but you also know what the upside potential is, and that adds comfort, especially into and through the retirement years when you want stability in a portfolio. Structured notes offer that.
Speaking of retirement, is this a good way to create income?
It's an ideal way to create income, and we do that for a lot of clients here at Integrated Financial Services. I mentioned outcome-based investing. When you are able to know ahead of time an interest rate, and you know that interest rate is going to be paid, you built in some downside protection. You can design a stream of income where you do not have to rely on selling stocks or bonds in a down market. And so for many people experience that, many retirees experience that, having to sell equities that have depreciated this last year in order to generate income for retirement. That is a vortex that, as much as possible, we'd like to avoid. And structured notes offer a wonderful alternative to do that.
Yeah. This is really helpful to talk this through, Chris. And like I said, some really interesting opportunities here. If somebody would like to talk to you more about structured notes, what's the best way to reach you?
Reach us at our office. Our number is 509-467-5117, or just jump out to our website, myifsteam.com.
All right, Chris, thank you very much.